It is the summer of 1790, and the future of American finance is being decided in whispers. In Philadelphia, inside candlelit rooms thick with ink, paper, and ambition, merchants argue over debt. Outside, horses clatter over cobblestones. This is not just a city, it is the capital of the United States. Congress meets here. The Treasury operates here. The nation's money flows through this place. 200 miles north, New York is something else entirely. A port city, loud, chaotic, commercial, but politically secondary. It has no claim to being the center of American power. And yet, quietly, methodically, New York is laying a trap. Within a single generation, Philadelphia will lose its grip on the country's financial system. The institutions born here, banks, brokers, exchanges, will still exist, but they will no longer matter. Capital will migrate. Liquidity will concentrate. Power will centralize. This is not a story about crime. It is not a story about corruption. It is a story about structure. How did a city that invented American finance lose it? How did New York, not through force, but through incentives, absorb the stock market itself? To answer that, you have to understand how money chooses its home. The genesis and the promise Philadelphia does not stumble into finance by accident. It is engineered into the role. This city is the intellectual engine of early America. Benjamin Franklin prints money here. The first bank of the United States is chartered here. The federal government borrows, spends, and repays here. If you want safety, legitimacy, and proximity to power, you operate in Philadelphia. In 1790, the federal government assumed state war debts, a controversial move championed by Alexander Hamilton. The logic is radical for its time: consolidate debt, stabilize credit, and bind the nation together financially. That decision creates something new. For the first time, America has tradable government securities, bonds that can be bought, sold, and priced by the market. These are not abstract promises. They are claims on the future tax revenue of the United States itself. Philadelphia becomes the natural hub for this market. Brokers gather informally. Prices circulate by word of mouth. Deals are handwritten, slow, and personal. In 1791, this activity formalizes with the creation of what will become the Philadelphia Stock Exchange, the first organized securities exchange in the United States. Its promise is stability. The Philadelphia market is conservative by design. Membership is limited. Reputation matters. Credit is personal. Deals rely on trust because information moves slowly. This is finance built to protect capital, not accelerate it. Think of it like a stone fortress. Thick walls, narrow gates, hard to enter, hard to abuse, but also hard to grow. And that constraint will become its weakness. The mechanism whiteboard breakdown. Here's how early American stock trading actually works. Step 1. The government issues bonds. Step 2. Wealthy individuals buy them directly or through brokers. Step 3. Those bonds trade among investors who want liquidity. But liquidity, the ability to buy or sell instantly, without moving the price, is not guaranteed. It emerges only where enough participants are willing to trade continuously. Philadelphia prioritizes creditworthiness over volume. New York will do the opposite. And that difference changes everything. The New York problem New York has a problem in the 1790s. It is commercially vibrant, but financially fragmented. Merchants trade shipping shares, bank stocks, insurance contracts, often chaotically. Prices fluctuate wildly. Speculation is rampant. Trust is thin. In 1792, after a market panic nearly collapses local trading, a group of brokers meets under a buttonwood tree on Wall Street. They sign a short agreement. It is deceptively simple. They promise to trade only with each other and to charge fixed commissions. This becomes the foundation of the New York Stock Exchange. But here's the key difference. The New York model is not built around safety. It is built around flow. Anyone who can bring trades gets attention. volume is rewarded. Speed matters more than pedigree. Deals happen faster, more frequently, and with less scrutiny. If Philadelphia is a fortress, New York is a river, messy, dangerous, but unstoppable. The central paradox emerges: Philadelphia holds political power. New York attracts economic motion. And markets do not follow authority, they follow liquidity. This is the paradox at the heart of the story. The system designed to protect capital becomes less relevant than the system willing to move it. Philadelphia believes legitimacy guarantees dominance. New York understands that participation does. Every new trader makes the New York market more useful. Every additional trade tightens spreads, improves prices, and draws more participants. This is not theft. It is gravitational capture. The first shift by the early 1800s, something subtle happens. Government bonds once traded primarily in Philadelphia begin pricing more efficiently in New York, not because New York is safer, but because more buyers and sellers are at any given moment. Banks notice, insurers notice, foreign capital notices. Liquidity becomes a signal of truth. And once that signal flips, it is almost impossible to reverse. Philadelphia still has the institutions. New York now has the market. The propagation by the early 19th century, the shift is no longer subtle. Philadelphia still believes it is the center of American finance. The banks are here. The legal authority is here. The legacy is unquestioned. But markets do not care about legacy. They care about execution. New York's exchange begins to do something radical for its time. It standardizes chaos. Instead of discouraging speculation, it absorbs it. Instead of filtering participants, it aggregates them. Every new trader, reckless or cautious, adds another data point to price discovery. This creates a feedback loop. More traders mean tighter prices. Tighter prices mean better information. Better information attracts more capital. Philadelphia's market remains deliberate. New York's becomes reflexive. And here's the key shift. Price moves from being an opinion to being a signal. In Philadelphia, prices are negotiated. In New York, prices emerge. The infrastructure advantage, then technology intervenes, not computers. Not algorithms, paper, boats, telegraph wires. New York is a port city first, a financial city second. Ships arrive daily carrying European capital, news, commodities, and risk. Information enters New York faster than it reaches Philadelphia, sometimes by days. In markets, time is leverage. When the telegraph arrives in the 1840s, New York connects it directly to trading activity. Prices update faster. Arbitrage tightens. Delay becomes costly. Philadelphia adapts but cautiously. And caution, in markets, is indistinguishable from hesitation. The mechanism whiteboard breakdown. Here's the structural flaw step by step. Liquidity compounds. Each additional trader increases the usefulness of the market for everyone else. Speed becomes credibility. Faster price updates appear more real, even if they are noisier. Volume disguises risk. High activity feels like stability, even when underlying assets are fragile. Capital migrates automatically. Institutions follow where trades clear fastest, not where rules are strictest. Philadelphia's model assumes quality protects relevance. New York's model proves relevance defines quality. Once that loop begins, there is no neutral ground. The hidden flaw, and now we reach the flaw no one sees yet. New York's market is winning, but for the wrong reason. It is not more accurate. It is not more ethical. It is simply louder. Liquidity creates the illusion of safety. When you can always sell, you assume you are not at risk. But liquidity is conditional. It exists only as long as confidence holds. Philadelphia's market is illiquid, but resilient. New York's market is liquid, but brittle. This is the contradiction. The structure that concentrates capital also concentrates panic. But in the 1800s, the system has not yet been stressed enough to reveal this weakness. Instead, the benefits dominate. The point of nitrogen monoxide return, By the late 19th century, the transition is complete. Major corporations list in New York. Railroads raise capital there. Industrial giants price their shares there. Foreign investors treat New York quotes as authoritative, even for companies headquartered elsewhere. Philadelphia's exchange still operates, but it no longer sets the narrative. And markets run on narrative as much as numbers. Once New York becomes the place where prices are believed, it becomes the place where prices are made. The stock market has not been stolen. It has been redefined. The unseen consequence, what no one realizes yet, is that America has made a trade. It has exchanged decentralization for efficiency, stability for speed, redundancy for scale. And that trade will not reveal its cost for another century. But the blueprint is now set. One dominant financial center. One liquidity engine. One point of failure. The catalytic failure for decades, the flaw remains dormant. New York's dominance feels justified. The market is deeper, faster, and more efficient than anything America has ever seen. Capital formation accelerates. Railroads are built. Industries scale. The country grows into an economic power. Then the system is tested, not by fraud, not by war, but by synchronization. As capital concentrates in one place, behavior begins to synchronize as well. Investors read the same prices, react to the same signals, and rush through the same exits. In 1907, that synchronization snaps. A failed attempt to corner copper markets triggers a cascade of bank runs. Liquidity so abundant in normal times vanishes overnight. Trust evaporates faster than money can move. There is no central bank, no backstop, no lender of last resort. The New York market freezes. And when it freezes, the entire country freezes with it. Philadelphia cannot compensate. Neither can Boston, Baltimore, or Chicago. The redundancy that once existed is gone. Finance has become centralized enough that failure is no longer local. The paradox is now undeniable. The structure that made markets efficient also made them fragile. The mechanism whiteboard breakdown. Let's slow this down and trace the plumbing. Capital concentrates where liquidity is highest. Liquidity attracts leverage. Leverage amplifies returns and losses. Losses trigger forced selling. Forced selling destroys liquidity. No liquidity means no prices. No prices mean no trust. When one city dominates price discovery, every shock propagates through the same channel. There are no fire breaks. Philadelphia's older system absorbed shocks quietly because trades were slower, smaller, and fragmented. New York's system absorbs growth spectacularly, but failure catastrophically. The market has evolved from a network into a single machine. The response that locks IT in. The panic of 1907 does not reverse New York's dominance. It cements it. Instead of decentralizing finance, the solution is to reinforce the center. The Federal Reserve is created in 1913 not to dilute New York's power, but to stabilize it. Liquidity is institutionalized. Backstops are formalized. Crises are managed centrally. The lesson learned is not concentration is dangerous. The lesson learned is concentration must be controlled. And so the architecture hardens. The modern thread, this is not a history lesson. It is a template. Every modern financial system repeats this pattern. ETFs promise liquidity, but concentrate flows. Index funds democratize investing, but synchronize behavior. Crypto exchanges decentralize ideology, but centralize execution. Private markets reduce volatility by hiding prices until they don't. The instruments change. The mechanism does not. Liquidity attracts capital. Capital attracts leverage. Leverage concentrates risk. And when risk crystallizes, it does so where liquidity once lived. The analytical takeaway, the checklist. If you want to understand modern finance, ask 3 questions always. 1. Where does liquidity truly live? Not where it is advertised, where it survives stress. 2. What assumptions depend on continuous trading? If prices must always exist for the model to work, the model is fragile. 3. What happens if everyone exits at once? If the answer is the system freezes, you have found the risk. Philadelphia lost the stock market because it protected capital instead of attracting participation. New York won because it optimized for flow instead of safety. Modern markets still make that trade every day. Closing, the resolution. So the story does not end with theft. It ends with architecture. New York did not steal the stock market from Philadelphia through deception or force. It absorbed it by becoming the place where prices moved fastest, trades cleared easiest, and capital felt most alive. But that victory came with a cost. The American financial system gained speed and lost redundancy. It gained efficiency and surrendered resilience. Understanding this is not about predicting the next crash. It is about seeing the system clearly, because the most dangerous risks are never hidden in the shadows. They are embedded in the structures we rely on most. And once you see the architecture, you can never unsee it.